All right, so get this. A recent report is saying that the Indian stock market could give us like almost 7% returns each year for the next few years.
Yeah, 6.7% to be exact.
Pretty juicy, right?
Yeah, that's the headline number from one of the indicators we're going to break down today. So is it reliable? What does it mean for us? Like, should we just pile in now?
Exactly. That's what we're here to figure out.
We're going deep on this one. This is a deep dive into a weekly newsletter, Volatility Coaches of India report.
Okay.
From March 23rd, 2025.
Very recent.
So it's like our weekly briefing. Yeah, super fresh data on the Indian market.
Excellent.
And it pulls from like a bunch of sources like volatilitygame.com, valuestocks.ns, investing.com, gurufocus.com.
Wow, that's comprehensive.
So yeah, it paints a pretty good picture.
Excellent. I'm excited to get into it.
All right, let's go.
So the mission here for you listening is basically to unpack the key numbers and analysis from this newsletter so you can get a clear sense of, where the Indian market is right now and where it might be going, but without drowning you in data.
Right, without like totally overwhelming you.
Exactly.
So let's jump in. The newsletter starts with these things called RVCC parameters.
Ooh, RVCC parameters. That sounds fancy. What are those?
Right. It sounds kind of technical, but basically think of it like a health checkup for the market. They're using a few key indicators.
Okay, I like it. Keep going.
All right. So first up, we got the PE ratio, the price to earnings ratio that's gone up from 19.91 to 20.8.
Okay.
In just a week. From March 16th to March 23rd, 2025.
Got it. And the PE, is that basically telling us how expensive the stocks are?
Yeah, in a nutshell.
Okay. And
then there's the PB ratio, price to book. So that compares a company's market value to its assets, like its stuff. And that also ticked up from 3.33 to 3.48.
So higher PE, higher PB, basically investors are paying more for every rupee of earnings or book value.
Yeah,
right?
Exactly. They're willing to shell out a bit more for a piece of the action.
I see. Now, what about that market cap to GDP ratio? So that one jumped up quite a bit.
That's a big one, yeah. That one moved from 110.94% to a hefty 115.57%.
Whoa, that is hefty.
Now, you might hear this called like the Buffett indicator, where we compare like the whole value of all the public companies to the size of the country's economy.
Interesting.
And so if the stock market's value gets too big compared to how much the economy is actually producing, it can be a sign that things might be getting a little too hot, a little frothy,
Okay, so the market's looking a bit pricey compared to how much the economy is actually churning out.
That's what this indicator is saying.
Got it. And then there's the RSI. They talked about that too, right?
Yes, the RSI, that one had a huge jump from 49.32 to 65.
Oh, that's a big jump. What's going on there?
The RSI, or Relative Strength Index, it's all about momentum. It tells us like how strong the price moves have been recently.
Got it.
And typically, if it's above 50, it suggests that prices have been going up more than down. And 65, that's a pretty strong upward move.
Interesting. So we're seeing higher valuations, stronger upward price movements.
Yeah, that's the story these early indicators are telling us.
Got it. Okay, so then the newsletter also looks at what foreign investors have been up to. What's the scoop there?
Right. This is really important. We've seen a huge change in what they call FII, foreign institutional investor net open interest.
Okay.
Basically, in the week leading up to March 23rd, there was an inflow of 11,077 crore.
Whoa, so that's money coming into the Indian market from foreign investors.
Yep, big inflow.
Huge. And that's a big turnaround from the previous week, which had an outflow, right?
Exactly. The week before saw an outflow of 2,943 crore.
Wow, so it went from negative to super positive. What does that usually mean when we see that kind of flow into the Indian market?
Yeah, so typically it signals a renewed optimism, like those foreign investors are getting more confident in the Indian market, and that increased demand can push prices up even more and just like boost the overall mood, the sentiment.
I see. So that likely played a part in those upward movements we saw in the RVCC parameters we talked about earlier.
Could be, yeah.
Okay, so speaking of upward movement, let's talk about the Nifty Y, the big benchmark index. It closed at 23,350 on March 23rd. A nice jump from the previous weeks, closed at 22,397.
Yep, good week.
And it's also above its 13-day exponential moving average, the 13 EMA, which was at 22,781.73. So what does that tell us about the short-term trend?
Okay, so the Nifty White closing higher just means that the overall value of those top Indian companies has gone up, right? Makes sense now, the 13 EMA, that's like our short-term trend line. And when the price is above that line and it's moving up like it is now, it usually means that the short-term trend is bullish, so prices are probably going to keep going up for a bit.
Yeah. So the short-term picture for the Nifty is looking positive.
So far, so good. Yeah.
Now, what about volatility? The newsletter mentioned the VIX. What's that all about?
Right. So the VIX in India, it basically measures how much volatility or how much the market expects prices to jump around in the near future. And it actually went down from 13.28 to 12.58. So lower VIX usually means investors are feeling calmer. They're not expecting huge price swings. It often comes with periods of stability or, when the market's moving up steadily.
Got it. So lower expected volatility often means a calmer or steadily rising market.
Yeah, exactly.
Okay, so now let's talk about the big one, the Buffett indicator, and this prediction of a 6.7% annual return for the Indian market.
Yeah.
How do they even come up with that number?
All right, this is where it gets interesting for anyone thinking long term,
Yeah.
So they break down this expected return into three parts. This is based on the original idea behind the Buffett indicator. So first, they look at how much they think the Indian economy is going to grow measured in local currency, and they're estimating 6.86% growth.
Okay, sounds promising.
Then they add in the current dividend yield, which is 1.55%. So that's the cash payout you get from owning stocks.
Right, makes sense.
But then they also include something called valuation reverse to the mean, and that comes out as a negative 1.76%.
Okay, so the good stuff is coming from the growing economy and those sweet dividend payouts. But this valuation reverse to the mean, that's putting a damper on things. Can you explain that in a way that makes sense, like for the average person?
Sure. So imagine the market is like a seesaw.
Okay, back it.
And right now it's tilted up on one side because valuations are high, maybe higher than their historical average.
Got it, like that market cap to GDP ratio we talked about earlier?
Exactly. Now, historically speaking, that seesaw tends to level out over time. It wants to come back to a balance. So this valuation reverse to the mean factor is basically saying, hey, those high valuations might cool off a bit, and that could bring down the overall return you actually get.
Oh, that makes total sense. So even with a strong economy and dividends, those high prices might come down a bit eventually and eat into some of those gains.
Right. It's like a reality check built into the forecast.
Got it. Now, they also mentioned a modified Buffett model, right? Did that one give a different result?
It did slightly. Yeah, the modified model uses a slightly different way to calculate that valuation reverse to the mean thing, and it comes out as negative 1.77%.
Okay, so tiny difference.
Yeah, and because of that, the forecasted annual return from that model is 6.6%.
Got it. So pretty much the same as the original model, around 6.5%.
Exactly. They're both in the same ballpark, which gives us more confidence in that range, somewhere between 6.6 and 6.7% for those future returns.
That's good to know. Okay, so now I want to talk about the strategic observations. The newsletter had some advice on how to actually navigate the market. What were they saying?
Right. They give some practical tips. For instance, they said that if the Nifty were to drop below 22,000, that might be a good time to buy more equity in a staggered manner. So not all at once, but gradually.
Okay, so like dip your toes in slowly.
Right. Spread it out.
Got it. And what else?
They also suggested thinking about a multi-asset strategy if the market dips that low, which means putting your money in different places, not just stocks.
Okay, so diversify, don't put all your eggs in one basket.
Exactly. Spread the risk.
Makes sense. What other strategic insights did they offer?
They also said that the lower we go, investors might want to think about switching from flexi-cap funds to multi-cap funds.
Okay, hold on. Can you break down what those funds are for the folks who might not know the difference?
Sure. So flexi-cap funds basically give the fund manager total freedom to invest in any size company, large, mid-cap, small-cap, whatever they think is best. But multi-cap funds, while they also invest across different company sizes, they usually have to stick to a certain mix, like they have to hold a certain percentage in each category.
Got it. So maybe the newsletter is suggesting that if the market takes a downturn, certain types of companies like mid-caps or small caps might become better deals relative to the big guys.
Could be. Yeah, it's a nuanced shift in strategy they're hinting at.
Makes sense now. Did they talk about any specific sectors of the economy that are looking particularly interesting right now?
They did. They specifically mentioned banking, finance, IT, and pharma. They're calling those out as sectors to watch right now.
Why those sectors in particular?
Well, those are often seen as like the backbone of the Indian economy,
Right, the heavy hitters.
Exactly. And what happens in those sectors can have a big impact on the whole market.
I see. So definitely keep an eye on those sectors, things like regulatory changes, technological advancements in those areas. They could really shake things up.
For sure, yeah.
Now, the newsletter also looked back at their past RVCC parameter calls going back to January 2022. What's the main takeaway from that longer-term view?
Well, I think the biggest thing is that it shows how much market assessments change over time. Looking back, their RVCC parameters have pointed to all sorts of trends, negative, positive, neutral. It's been all over the place.
So the market's a wild ride. It doesn't just go in one direction.
Right, and their outlook isn't static. It's constantly evolving with the data.
So it's not a crystal ball.
Yeah.
It's more like a compass that's constantly adjusting.
Exactly. It's all about adapting to the ever-changing landscape.
Got it. And speaking of adapting, the newsletter pointed out a very recent development, a trend reversal, they called it, on March 21st, 2025. That sounds significant.
It is, yeah. Just a couple of days before this newsletter, they basically said, hey, based on what we're seeing now, it looks like the market trend is reversing and heading in a more positive direction.
Interesting. So a shift from maybe a cautious stance to a more optimistic one.
And that's what it sounds like, yeah.
Okay, so a recent shift towards a more positive outlook. Now let's talk about how different parts of the market are performing. The newsletter mentioned small and mid-cap stocks.
Mm-hmm.
What's the situation there?
Right. As of March 23rd, 2025, both the Nifty Small Cap 100 Index and the Nifty Mid Cap 150 Index are in the green, according to their analysis.
Okay, so they're seeing continued strength in those segments, the small and mid-cap companies.
That's what it looks like, yeah.
And those are the ones that often have higher growth potential, but also come with more risk, right?
Exactly. Higher risk, higher reward.
Okay, so good information for folks who are either already invested in those types of companies or thinking about it.
Definitely something to keep in mind.
All right, so last but not least, the newsletter gave us a snapshot of how different sectors performed on March 23rd, 2025. What were some of the key takeaways from that day?
So this is where it gets really interesting. We see this overall trend reversal to positive. But when we look at the actual numbers from March 23rd, most of the major indices like the Nifty 100, the Nifty 500, even the mid-cap and small-cap indices, they all actually went down that day.
So even though the overall trend is supposedly turning positive, that specific day saw a lot of red across the board.
Yeah, it happens, even within a larger positive trend, you'll always have those day-to-day fluctuations. And what's interesting is that the small-cap indices had bigger drops compared to the larger companies.
So it's a reminder that even with a positive outlook, the market can still be a bit of a roller coaster, especially for those smaller companies.
Absolutely. It's all about managing those expectations.
Exactly. And this data also gives us a look at the PE and PB ratios for different parts of the market. Did you notice anything interesting there?
Yeah, the mid-cap and small-cap indices generally have higher PE and PB ratios compared to the Nifty 100, which tracks the big companies.
Right, so investors are willing to pay a premium for those smaller companies because of their growth potential.
That's usually how it works, yep.
And, of course, we also get a look at the dividend yields for these different indices, which are part of the overall return picture we talked about before.
Yep. Dividends are a key part of the story.
Okay, so we've covered a lot of ground here. A comprehensive look at the Indian stock market based on this recent newsletter. Let's sum it up for our listeners. What are the most important things to remember from this deep dive?
All right, so big picture. The Buffett indicator, both the original and the modified version, are pointing to a potential yearly return of around 6.5% to 6.7% for the Indian stock market in the coming years.
Okay.
And that's based on the expected economic growth, the current dividend yield, but it's also taking into account those current high valuations.
Right.
We also saw that big shift in sentiment from foreign investors pouring money back into the market, and the Nifty Y, our main index, is in a short-term upward trend with volatility relatively low.
Got it. And let's not forget those strategic takeaways, that potential buying opportunity if the Nifty dips below 22,000, the idea of diversifying with a multi-asset approach.
Yeah.
Those key sectors to watch: banking, finance, IT, and pharma.
Yes, all important points.
And of course, the newsletter's own analysis is pointing to a recent trend reversal towards a positive outlook. But even with that, we saw some market dips, especially in the small cap space, on the day the report came out.
Yeah, that's the market for you. Always full of surprises.
Absolutely. Now, here's a question for you listening. Taking all of this into account, the long-term forecast, the positive trend reversal, the short-term ups and downs, How does this change your own investing strategy? How are you thinking about those highlighted sectors? Are you digging deeper into any of them? It's all about connecting the dots and forming your own informed view.
That's right, because ultimately investing is about making decisions that align with your own goals and risk tolerance.
Exactly. So keep learning, keep researching, and as always, stay tuned for more deep dives coming soon.
See you next time.